My name is Sai Kamal. I'm the Academic Research Director of the Institute for Economic Affairs. If you're joining us for the first time, let me just say a few words about the IEA. The Institute for Economic Affairs is Britain's oldest free market think tank. We're also an educational charity founded in 1955 to improve the understanding of the fundamental institutions of a free society by analysing and expounding the roles of markets in solving economic and social problems. I'm also a Professor of Politics and International Relations at the St Mary's University in Twickenham. Welcome to the latest of our webinars from the IEA. During lockdown, we are producing content on an almost daily basis. You'll find much of it on IEA London YouTube page, also on Podbean and elsewhere, and also on our website at www.iea.org.uk. Today, we'll be discussing the short and medium-term economic damage from coronavirus, and I'm delighted to be joined by Sir Vince Cable and Sam Bowman. Sir Vince Cable is a visiting professor at St Mary's University in Twickenham. He's the former leader of the Liberal Democrats Party in the UK and a former Member of Parliament for Twickenham. And between 2010 and 2015, he was a Secretary of State for Business, Innovation and Skills. His background is in economics and he's published numerous books in that area. Sam Bowman is Director of Competition Policy at the International Centre for Law and Economics. He's also a Senior Fellow of the Adam Smith Institute, where he was previously Executive Director, and an advisor at Fingleton, a regulatory risk advisory firm. So thank you for joining us today. Let's first of all ask Vince to make his opening remarks.
Well, thanks to the IEA for organising this. I think probably there are two big questions amongst most of the participants, which is one, how do you resurrect a liberal competitive market economy from current collapse? Governments are effectively in control of economies as they are in wartime, so how does one revert? And I think the second big question, which is how you balance economic considerations against the ethical considerations which underpin public health policy. In my weekly column for The Independent last week, I looked at the question about what would happen if you applied the cost-benefit approach used in the health service with, say, testing drugs in NICE. And there is, under almost every assumption, the lockdown makes absolutely no economic sense whatever. But of course, it's not economic considerations here, but how do we balance the economics of the lockdown from looking at the benefits and costs? But I just want to make a few remarks to give discussions about the macro and the microeconomic aspects of this. Now, on the macroeconomic side, we got a massive supply shock imposed by government necessarily, shutting down the economy or large parts of it. And we've got an extreme demand shock, millions of people being put out of work, potential impoverishment, weak welfare response, natural nervousness about spending, and natural nervousness by business in terms of investment. We've got a policy response, which is an urgent attempt to boost supply by keeping businesses which are solvent but illiquid going, and we've got an urgent injection of demand to try to prevent a demand collapse, the use of universal payments in Japan and the United States, or selective payments through our means-tested universal credit, and we've got the furloughing of labour, temporary labour subsidies. Now, the consequence of all this, and it's my central point on the macroeconomics, is that we're going to emerge from this with massive levels of government debt, combination of collapse of tax revenue and all the additional spending. And the question then will be, how do we manage the debt? I don't think it will be feasible to go back to 2010 and try to work down debt levels in the way that the government did at that time. Some people will argue for it. I think we're much more into the world that was described 120 years ago by Irving Fisher, the world of debt deflation, and which is experienced currently in Japan through balance sheet recession. And the question will be, how do we manage that? And it, of course, not just a national problem, it will be international. There will be debt everywhere, public, private, corporate. Now, I think the Japanese model is worth studying because they're trying essentially two approaches to escape from debt deflation, which we're now going to have to on a much bigger scale. One of which is Abenomics, which is letting fiscal monetary policy and structural reform run flat out, running big fiscal deficits to try to reduce debt. I mean, counterintuitive, but what they're trying to do. And what is creeping in, which is overt monetization. I mean, instead of just QE, central banks buying up bonds, with the assumption that you redeem or you eventually remarket the bonds, I think we're beginning to get an understanding that there is no question of government ever being required to repay, and there is, monetization of the debt. And providing this is under the control of the central bank, like the Bank of Japan, which has a strong anti-inflation commitment. This doesn't seem to me fundamentally problematic, but it is something we need to discuss. And our own central bank, ECB, are being very coy about this, but it is a big subject coming over the horizon. I think finally, just say one or two brief comments, which Sam will develop, I think, in more detail about the microeconomics of this. First of all, we are getting, or potentially getting, the closure of very large numbers of companies, not for competitive reasons, not because of commercial failure, but simply closed by government under fiat, because they haven't got cash, though they may be perfectly solvent, or they may be solvent on a long-term basis, but not in terms of the short-term reporting requirements required by the authorities. And the big data companies, grew by expanding market share. They're very unprofitable for a long time. And a lot of companies like that, innovative companies, will go down. And I think we need to discuss the implications of that. Second, we're getting the use of conditionality in the availability of government bailout funds. What form should this conditionality take? Should it be some crude test of profitability, or should we be taking into account things which people are now asking for, like, do they have a record of avoiding taxes or other criteria? I think thirdly, we're beginning to get a return from lockdown through sector-level protocols. I mean, we're not talking about cartels because it's not price fixing, but agreements. A good example today with the gyms, which are preparing for opening up, and they're setting a set of standards. It's the industry association which does it, and presumably the industry association reflects the views of a particular group of its members. So we're going to see this across the board, where industry associations are negotiating with government the ground rules for the future market. And then finally, of course, I've just been talking here about the UK, but this is a global problem. We potentially are faced with very serious nationalism. We've seen this with the supply of goods in the pandemic, but even before that, the use of security criteria to introduce protectionist measures. As long as people like Trump are in decision-making positions, there is a very real risk of a reversion to beggar my neighbor economic nationalism, and that would be very difficult to restore a functioning market economy while that happens. Thank you.
Well, thank you, Vince, for those opening remarks. Sam, Vince there talked about some of the macro aspects, some touched upon the micro, and then obviously then talked about global politics. What are your views on those issues?
Well, thanks, Said, for having me, and thanks to the IEA for putting this on as well. Some of the points I want to touch on begin with explaining why I think it's really important to understand this as not being like a normal recession. And because it's not like a normal recession, many of the responses to a recession that particularly free marketeers may favor might not be appropriate in this case. So a few reasons that it's not a normal recession. One is it's self-inflicted. We want people to stop spending money. We want people to stop producing things. These are part of the necessary response to the virus that we need people to do. And that's very, very unusual. There's virtually no other recession I can think of where we have wanted people to stop producing and going about economic activity. The next is that these conditions are temporary. And what I mean by that is There are very real changes in the economy, but these real changes are not permanent changes that we want the economy to adjust to. So unlike, for example, if there had been a huge oil spike where we do need some businesses to go bust because we need to adjust to the new reality, there is a temporary reality that we have to make do with, but we don't want a permanent adjustment to that. The next point is that, as Vince has said, it cuts across productive and unproductive businesses evenly. Unlike the kind of Austrian view, for example, of a recession as sort of shaking out unproductive, insolvent companies and freeing up the resources that are tied up in those companies for better uses, very, very productive, very perfectly solvent businesses have been shuttered and have to be shuttered, that are facing now a huge, huge gap in their incomes. And these companies going bust is just a net loss for society. There's no other thing that those resources can be used for. The high street property units, for example, that restaurants use are not in demand for other uses. So there's no real case for this sort of shaking out of the economy that some people favor in certain recessions. And the final point about why this is unusual is that it's not an insurable risk. Unlike some kinds of risks where we can insure and effectively redistribute within an insurance pool from people who have been lucky by avoiding the risk to people who have not been lucky by not avoiding the risk, no private company could have been large enough, no private insurer could have been large enough to provide that kind of insurance, which is why we have to rely on the state as an insurer of last resort. So this is why in the short term, I favor the cold storage response. Although I look at it, Vince talked about it in macro terms, I think about it more as sort of big micro. We're not exactly trying to avoid a collapse in spending. We're just trying to make sure that households are getting enough in real resources. NGDP certainly, I think it's unavoidable that NGDP will collapse just as much as real GDP. And that's okay in the short term. It's in the long term that we have to start thinking of macro factors like spending. I think that conditionality is probably not appropriate at this point. So having strings attached or trying to separate kind of good businesses from bad businesses when we think about supports is probably not a good idea at this point because it's such an emergency. It's probably better to spend too much money than too little. That will change, and I'll get onto that in a minute. But the point of this shutdown is really to buy time. We need time to suppress the initial outbreak. We need time to learn about the virus. We need time to roll out a containment strategy and the tools to do with contact tracing and isolation of new cases that do arise. And then finally, we need time to develop a vaccine. And it's important to remember that the alternative wouldn't be business as usual. So in places like Sweden, where they haven't imposed a lockdown, people are still doing kind of voluntary personal distancing, and there's still a huge drop-off in demand for things like pubs and restaurants and so on. And anybody who is around London at the beginning of just prior to the lockdown will also know that restaurants were empty, pubs were empty. So a lot of the economic effects we would still be feeling whether or not the government had imposed a lockdown. But it's clear, I think, that we can't have this kind of lockdown for more than a few more months. The cost may become enormous because things that we can live without for a few months begin to become essential. So, for example, repair the kind of equipment that we would need to repair computers or cars or other essential things may not be considered essential now because we've got reserves of those things. But at some point in the future, we will run out of those reserves and we'll need to bring those kinds of factories and manufactories online. That's a kind of small, trivial example, but the complexity of the economy means that you can probably run for a few months with things shut down, with lots of things shut down, but it's going to get harder and harder and more expensive as months go by. And we need to remember we're only 1 month into this lockdown. So if we assume, let's say, a 3-month lockdown after which we come out, I think that in a lovely, perfect world, we would expect, perhaps a vaccine in September or something like that. But let's assume that isn't going to happen, and we're waiting more like 12 or 18 months for a vaccine. So then in between the recovery period and the current lockdown period, we have this period of kind of limbo, or sort of purgatory economics period, where we're not quite a business as usual. We have lots and lots of measures to prevent the emergence of a widespread outbreak. And yet we still want as much economic activity that can take place within those constraints as possible. So this is sort of what the situation that South Korea, Taiwan, Hong Kong are in right now. And this involves lots of contact tracing of people who have been around anybody who is found to have the virus, lots of social distancing, restaurants running at 40% or 50% capacity because they have to spread out the tables and things like that, masks everywhere, Perhaps the isolation of people who have COVID or who have been around people who have COVID, taking them and requiring them to spend a week in quarantine. And this period may mean that lots of businesses need to continue to support. So restaurants, retailers, anywhere where people are mixing around with each other and where it's not possible to do effective contact tracing, as it might be in an office where you know exactly who's been in that office every single day. These places may need to bring in kind of one out, one in, one out rules. They may need to have very significant limits on how many people can actually go through those businesses per day. And for these businesses, it might be appropriate to have continued supports. So for example, a business rates holiday might be reasonable to continue for certain businesses. And this is where conditionality and where targeting may become feasible. Now, usually I would oppose any kind of business rates holiday or any kind of business rates cut, because the evidence is very strong that cutting business rates ends up going into landlords because rents rise in proportion to the cut. But if you could make it a credible cut, a credibly temporary cut, that lasts 1 year, for example, then that danger should be avoided. And if we can do that, then that should be a reasonably efficient way of transferring money to affected businesses without creating weird incentives and without distorting other incentives in other ways. But the big danger there is lobbying from those business groups to make that kind of cut permanent. I think that's very, very dangerous. And that's something that if the government is looking at a business rates holiday for retailers and so on, it needs to be on guard against lobbying to make those things permanent. Now, I agree that as we come out of that period and as we come out of the lockdown altogether, Abenomics might be quite a good model, or might be quite a good kind of frame of looking at. And this is the kind of the triple approach of supply side reforms, fiscal policy if necessary, and monetary policy doing a lot of the work. Although we should remember, and this is a cause for optimism, that Japan has lots of fundamental factors slowing growth that we don't have. So for example, Japan has a much, much older population and many, many more people retiring per capita than we have. And that's something that really there's nothing government can do there's basically nothing the Japanese government can do to increase growth in the face of things like that. But putting that to one side, as we come out of this, the tools that we would have available to us are, I think, much, much easier monetary policy aimed at keeping nominal GDP on trend. That may involve broader asset purchases. So we may see the Bank of England needing to buy not just gilts, but for example, foreign currency, equities perhaps, corporate bonds perhaps. And these things are quite unusual, but they would allow the Bank of England to effectively continue doing expansionary monetary policy as much as is necessary. It may be necessary to do fiscal policy, although I think that we should have a preference for monetary policy because it tends to be less distortionary. And then, of course, I think almost everybody would favor some kinds of supply side policies, although we'd probably disagree about which. I think the ones the government should be looking at are tools to promote investment. So the annual investment allowance being made unlimited so that businesses can effectively deduct all the costs of the capital investments they're making from their tax bill right away. And perhaps some kind of targeted employment cuts, so employer NICs and things like that. So the final question is kind of how to pay for this. And I'm sure we all agree that all borrowing is deferred taxation, but when we pay back, the taxation is important. And we have one thing that's very fortunate, which is that borrowing is extremely cheap. And so the OBR reckons that we're going to borrow an extra £218 billion over this period compared to what it had previously projected we would borrow. But at the 0.6% yield that we're paying on 30-year gilts, that's £1.3 billion a year extra interest. That's really very manageable. That's really, really very tolerable. So the question is, as a one-off cost, so because it's a one-off cost, we don't need the kinds of austerity measures that we may have needed in 2010, 2011 under the coalition government in order to sort of stem the tide of debt. We don't need to continue, we don't need to cut other spending because the spending cuts are already built into the supports we're doing because they're temporary. So once they stop, the debt borrowing stops and we're just left with this huge debt kind of principle that we have to maintain and eventually pay down. But then the question is, when do we pay it down? Because it's so cheap, we may not need to pay it down imminently. And it may be that we're better off waiting many decades, perhaps, as we did after the Second World War, to pay down that debt. And in the meantime, trying to do everything we can to increase growth in order to make it as small a sum relative to our total ability to pay as possible, And I think the comparison I would give is like parents trying to decide whether they should pay down their mortgage or support their child going into university. The first one might make them a little bit more relaxed about the kind of debt in their head that they've got, but the second one might, in the long term, make their family much better off. So overall, and to summarize, it's a very unusual recession that requires a very unusual response. I don't think there are general lessons that we can take about how we should treat normal recessions, but equally, I don't think there's that much we can learn about how we should treat this recession from our usual preference about recessions. We shouldn't expect things to get back to normal soon, but we should be prepared for a year or 18 months or even longer, perhaps, of this sort of in-between halfway house, not quite a lockdown, not quite business as usual. And that's where I think the economic response should be focused for now. Thanks.